The screen flickers. A transaction freezes midair. Somewhere in Brussels, a system administrator stares at a command prompt that shouldn't exist. The message is simple, timestamped 09.14, UTC, USD exclusion protocols engaged. Within 48 hours, every dollar-denominated wire transfer moving through SWIFT stops cold. In this simulation, we're watching the first 2 days after the global banking messaging system removes the US dollar from its network. No warning, no transition period. Just a quiet, instant severance. This isn't about why it happened. This is about what happens next, in real time, as the most traded currency on Earth suddenly can't move through the rails that carry 5 trillion every single day. And the first thing you notice isn't chaos, it's silence. The initial sign appears in Tokyo 17 minutes after the exclusion begins. A settlement desk at Mizuho Bank tries to confirm a $240 million treasury bond payment to a New York counterparty. The message won't route. The system returns an error code that doesn't match any known protocol. The trader refreshes. Same result. He calls compliance. Compliance calls SWIFT's regional node. The node confirms. Dollar-based messages are no longer supported. No explanation, just a policy update timestamp. Within 90 seconds, every major bank in Asia sees the same thing. Payments halt. Confirmations vanish. The flow just stops. But here's what makes this different from a technical glitch. The system isn't broken. It's working exactly as designed. It's just no longer designed to carry dollars. In New York, it's 3:31 a.m. The overnight treasury desk at JP Morgan Chase notices something wrong with their queue. Incoming wires from Europe aren't landing. Outgoing confirmations to Hong Kong aren't transmitting. At first, it looks like a server issue. Then the scope becomes clear. Every dollar-denominated message on SWIFT's network has been severed, not delayed. Severed. A managing director makes a call to the Federal Reserve. The Fed makes a call to Treasury. Treasury makes a call to Brussels. Brussels confirms the policy is active and irreversible. The call ends. No one speaks for 11 seconds. The question isn't how to reverse it. The question is what happens when 6.8 trillion in daily dollar transactions no longer have a messaging layer. By 6 a.m. Eastern, the first pension fund in Ohio tries to rebalance. The fund holds $1.4 billion in international equities and needs to sell a position in a German automotive stock to buy U.S. bonds. The sale executes. The euros arrive. But the system can't convert those euros into dollars and route them back through SWIFT to purchase the bonds. The transaction stalls. The fund's custodian bank tries 3 alternate routing paths. All 3 fail. The manager calls the back office. The back office has 14 other funds with the same problem. Every cross-border transaction that touches the dollar is now a manual negotiation with no standard settlement path. And this is just one fund in one state. But the first real sign wasn't visible yet. It appeared somewhere nobody expected. A shipping terminal in Rotterdam begins refusing to accept letters of credit denominated in dollars. Not because of sanctions, not because of policy, because the payment confirmation messages can't clear. A container ship carrying $43 million in auto parts destined for a Toyota plant in Kentucky is held at dock. The plant has the funds. The exporter has the goods. But the transaction layer between them no longer exists when SWIFT kicks out the US dollar. The cargo sits. Within 4 hours, 19 other vessels in the same terminal face identical holds. The goods are frozen mid-route, not because anyone decided to stop them, because the infrastructure to complete payment evaporated. In London, currency traders notice something strange at 11:09 a.m. GMT. The dollar is still trading on Forex platforms, but the bid-ask spread is widening. Normally, the spread on EUR.USD sits around 0.0001. Now it's 0.0034 and climbing. Liquidity is thinning. Market makers are stepping back. Why? Because even though people can still trade dollars, they can't settle large institutional cross-border trades the way they used to. The message layer is gone. Settlement requires bilateral agreements, correspondent banks, and manual confirmation chains that take hours instead of seconds. The friction is invisible to most people, but to a currency desk managing 800 million in overnight flow, it's a total reconfiguration. Some desks stop quoting dollars entirely. Others quote, but with spreads wide enough to cover the settlement risk, the dollar's price doesn't collapse. It just becomes harder to move. Somewhere in Singapore, a sovereign wealth fund tries to purchase $2.1 billion in U.S. Treasury bonds. The fund has the capital in a European bank. The transaction is straightforward. Sell euros, buy dollars, settle the bond purchase. Except now the euro to dollar leg can't route through SWIFT. The fund's broker suggests using an alternative messaging platform. The platform exists, but it's not integrated with the custodian banks that hold the treasuries. A workaround is proposed. Route the payment through a Canadian correspondent bank using CAD as an interim currency, convert to USD via a bilateral agreement, then settle. The process takes 9 hours. At a grocery distribution center outside Atlanta, the finance manager receives an email from their Canadian produce supplier. The supplier ships $90,000 in fresh vegetables every week. Payment is due on delivery, wire transfer, US dollars. The email is short. We can no longer accept USD payments via our usual banking channel. Please remit in CAD or arrange alternative settlement. The distribution center doesn't hold Canadian dollar accounts. Their bank offers to set one up, but it requires 3 business days and new compliance paperwork. The produce arrives tomorrow. Without payment confirmation, the shipment won't release from customs. The manager calls 6 other suppliers. 4 of them have sent similar emails. The center serves 48 grocery stores across Georgia. If the shipments stall, shelves start thinning in 72 hours. Not because of shortages, because payment rails collapsed when SWIFT kicks out the US dollar. In Washington, a policy briefing is convened at 10 a.m. on day 2. Representatives from Treasury, the Fed, State, and Commerce are present. The question on the table: can the U.S. operate its external financial flows without SWIFT? The answer is technically yes. Bilateral agreements exist. Correspondent banking networks are functional. The clearinghouse interbank payments system still operates domestically, but SWIFT was the universal translator. It allowed a bank in Sao Paulo to send a message to a bank in Seattle using a standardized format that both systems understood. Without it, every cross-border transaction becomes a custom solution. A lawyer from Treasury's Office of Financial Markets presents an analysis. If current transaction volumes attempted to route through non-SWIFT channels, settlement times would increase by an average of 11 hours. Operational costs per transaction would rise by 47. Error rates would climb from 0.02% to 1.4%. Across the entire daily flow, that's an estimated $9.2 billion in additional friction costs and 83,000 failed transactions per day. The room absorbs this quietly. Someone asks if there's a contingency plan. There isn't. By hour 36, something begins to change. Not loudly, but unmistakably. Corporate treasurers start shifting behavior. A manufacturing firm in Illinois holds $16 million in operating cash. Normally, that cash sits in a dollar-denominated account, earning overnight interest while waiting for deployment. But now, moving that cash across borders for payments or hedging has become unpredictable. The treasurer moves $9 million into a euro account and $4 million into a yen account, keeping only $3 million in dollars for domestic expenses. This isn't a vote against the dollar. It's a rational response to settlement uncertainty. When payment infrastructure breaks down, you hold liquidity in the currencies that still have reliable infrastructure. Across the corporate sector, this shift is small but widespread. Dollar balances drop by an aggregate $14 billion in 48 hours. It's not a crisis. It's a quiet recalibration. But it's a recalibration that wouldn't have happened if SWIFT still carried the dollar. In the derivatives market, a tension appears that few people outside the industry would notice. A pension fund in Canada holds a currency swap with a U.S. bank. The swap requires a quarterly payment of $31 million. The payment is due in 48 hours. Settlement normally happens automatically through SWIFT-linked systems. Now, the systems can't talk to each other in the usual way. The pension fund's risk officer contacts the counterparty. They agree to settle manually using a correspondent bank in London, but the London bank requires additional collateral to cover settlement risk, since the transaction is no longer moving through standardized channels. The pension fund posts an extra $2.4 million in margin. The payment clears, but the cost of the swap just increased by 7.7% due to infrastructure breakdown. Multiply this across thousands of swaps, and the derivative market's operational cost rises by an estimated $600 million per day. Not from market volatility, from settlement friction. A university endowment in Massachusetts manages $890 million in assets. About 30% of that is in international holdings, European real estate funds, Asian equities, emerging market bonds. Normally, the endowment rebalances quarterly using SWIFT-based wire instructions. The next rebalance is scheduled for 5 days from now. The endowment's CFO receives a memo from their custodian bank. Dollar-based rebalancing instructions can no longer be processed through standard channels. Alternative settlement arrangements are being established, but they will take 10 to 14 business days to finalize. The rebalance is postponed. The endowment's asset allocation drifts out of target. The investment committee reconvenes. A proposal is made. Shift a larger portion of the portfolio into domestic-only assets that don't require cross-border settlement. It's a small shift. But when 4,000 other institutions make the same small shift, the flow of capital out of international markets becomes measurable. At a mid-sized insurance company in Texas, the claims department processes a payout for a policyholder who was injured abroad. The payout is $78,000, and the policyholder is currently in Germany receiving treatment. The payment needs to go to a German hospital. Normally, this is a same-day wire. Now, the insurance company's bank explains that dollar wires to European institutions are experiencing delays due to SWIFT Sancta's exclusion of the dollar. Alternate routing is available, but settlement could take 4 to 7 business days, and the policyholder may need to cover currency conversion costs if the hospital won't accept delayed dollar payments. The claims manager calls the hospital. The hospital requests payment in euros to avoid settlement uncertainty. The insurance company doesn't hold euro accounts. They open one, which takes 2 days. The payment finally processes on day 6. The policyholder covers the gap with a credit card. The insurance company reimburses later. It worked, but it worked through improvisation, not infrastructure. In the back offices of multinational corporations, a quiet scramble is underway. A tech company based in California has 14,000 employees across 60 countries. Payroll is managed centrally and distributed via SWIFT-linked banking channels. The next payroll cycle is in 9 days. The Treasury team realizes that payments to employees in Asia, Europe, and South America might not process on time if they are denominated in dollars and routed through banks that relied on SWIFT messaging. The team reaches out to regional banking partners to establish alternative payment paths. Some countries can receive payments in local currency. Others require new accounts and compliance reviews. The company's payroll vendor estimates that 11% of international employees might experience payment delays of 3 to 5 days. Human Resources prepares a communication. The delay isn't catastrophic, but it's the kind of operational breakdown that wouldn't happen if SWIFT still carried dollars. All of this still traces back to that one moment when SWIFT excluded the US dollar from its network. Every delayed transaction, every manual workaround, every shifted balance, and rerouted wire originates from that exact decision. And what is becoming clear by the end of 48 hours is not that the dollar has lost value or trust. It's that the infrastructure surrounding the dollar has fragmented. The currency still exists. People still want it. But moving it across borders now requires friction that didn't exist 2 days ago. And friction, even small amounts, changes behavior. A company that could settle a payment in 90 seconds now takes 9 hours. A fund that could rebalance on demand now waits 2 weeks. A grocery distributor that could pay suppliers instantly now negotiates currency swaps. None of this is violent. None of this is loud. But all of it is real. In a trading floor in Hong Kong, a derivatives strategist pulls up a chart showing dollar transaction volumes across major financial centers. The line is falling, not sharply, but steadily. Tokyo is down 9%, Frankfurt is down 14%. Singapore is down 11%. The volumes haven't disappeared. They've shifted to currencies that still have frictionless settlement infrastructure. The euro, the yen, the yuan. It's not a crisis, it's a drift. And drifts, unlike crashes, don't reverse themselves, they compound. Every hour that passes with SWIFT excluding the dollar is an hour where businesses, banks, and institutions adjust their systems to work around the absence. Those adjustments become habits. Habits become infrastructure. Infrastructure becomes the new normal. By the end of day 2, the Federal Reserve releases a brief statement. It acknowledges the SWIFT situation. It confirms that dollar payment systems remain fully operational domestically and through bilateral channels internationally. It notes that settlement times for cross-border transactions may be longer than usual, while alternate routing arrangements are finalized. The statement is calm, it's accurate, but it doesn't change the reality on the ground. The dollar is still the most widely held reserve currency. U.S. Treasury bonds are still the deepest and most liquid market on Earth. But the infrastructure that allowed the dollar to move effortlessly across the global system has been severed. And in finance, infrastructure isn't optional, it's everything. A small detail emerges quietly in the final hours of the 48-hour window. A clearing bank in Switzerland begins offering a new service. By day 3, that number doubles. The system isn't replacing SWIFT. It's filling the gap SWIFT left behind. And the gap is widening. Every workaround that gets built, every alternate path that gets established, is a piece of infrastructure that doesn't depend on SWIFT, which means every piece is also infrastructure that reduces the pressure to bring the dollar back into SWIFT. The exclusion was supposed to be reversible, but the longer it lasts, the less necessary reversal becomes. Somewhere in a risk management office in Zurich, an analyst runs a scenario model. The model asks, if SWIFT's exclusion of the dollar remains in place for 90 days, what percentage of global dollar transactions would permanently migrate to alternative systems? The model returns an answer, 34%. Not because the dollar is weak, because the infrastructure adapted. The analyst saves the report and closes the file. Outside, the financial system continues. Trades execute, payments settle, markets function. But the system is different now, quieter in some places, louder in others. The rails have shifted. And once rails shift, they rarely shift back. If a moment like this ever reached where you live, if the payment systems you depend on suddenly required new paths, new accounts, new waiting periods, new costs, What would it mean for the transactions you never think about until they stop working?